Today, three central banks made three decisions, and almost nobody put them next to each other. In Frankfurt, the European Central Bank raised interest rates again. In Tokyo, the Bank of Japan, the place that kept rates near zero for most of 30 years, raised too. And in Washington, the most powerful central bank on the planet, the one every other country watches before it does anything, sat on its hands and did nothing. That last one is the story. Not because doing nothing is dramatic, because of why they had no choice. Meet Alex. Alex is 27, earns $58,000 a year, and has been sitting on a few $1,000s in a savings account for about a year now, waiting for the right moment to invest. He keeps hearing that rates are high, that the Fed is fighting inflation, that any day now things will get back to normal. So he waits. What Alex doesn't know is that the Fed isn't holding rates steady because it won the fight. It's holding because it physically cannot do the thing everyone assumes it can. Let me put this in a way that actually makes sense. Think of the global economy as a high-stakes poker table. Every central bank has a seat. When inflation heats up, the move is to raise the bet. You raise rates, money gets more expensive, people borrow less, spending cools, prices settle. That's the whole game. Raising is how you show strength. Raising is how you stay in control. The European Central Bank just raised. It can do that because Europe's governments, for all their problems, can still afford slightly higher interest on their debt. The Bank of Japan just raised. After decades of being too scared to move, even Japan decided inflation was real enough to act. Almost everyone at the table can still push their chips forward. Then the camera pans to the biggest player in the room, the United States. And the United States is already all in. Here's what that means in plain numbers. The American national debt is now over $36 trillion. Not million, not billion, trillion. And here's the part that changes everything. The government doesn't own that money outright. It borrows it, and it pays interest on it, the same way you pay interest on a credit card. As of this year, the interest payment alone on the national debt has crossed $1 trillion a year. The country now spends more just servicing its debt than it spends on its entire military. Now watch what happens when the Fed tries to raise rates in that situation. When the Federal Reserve raises interest rates, it doesn't just make your car loan more expensive. It makes the government's debt more expensive too. Every time that debt rolls over, and trillions of dollars of it roll over every single year, it gets refinanced at the new higher rate. So every rate hike the Fed makes is also a hike on the government's own credit card bill. Raise rates by 1%, and you can add hundreds of billions of dollars to what the country owes in interest every year forever. That's the trap. The Fed's main tool for fighting inflation is the same tool that blows up the government's budget. The brake pedal and the gas pedal got wired to the same cable. So when Alex hears that the Fed is holding steady to be cautious, that's the polite version. The real version is that the Fed is standing very still on a ledge, and it's telling everyone it meant to stand there. And inflation hasn't gone away. According to the Bureau of Labor Statistics, US inflation climbed to 3.8% earlier this year, the highest reading since 2023. A big piece of that is energy. Oil has been trading between $100 and $120 a barrel because of the war that started near the Strait of Hormuz back in February. Higher oil feeds into the price of nearly everything that has to be shipped, grown, or made. So the textbook says the Fed should be raising rates right now to choke that inflation off, exactly like the Europeans just did. But it can't, because raising rates into $36 trillion of debt is its own kind of disaster. So the most powerful central bank in the world is stuck choosing between two fires, and it's chosen to stand between them and hope the wind dies down. I want to pull on the Japan thread for a second, because it's the part most people miss, and it's the part that can actually reach across the ocean and hit your retirement account. For years, Japan ran the cheapest money on earth. Rates near zero, sometimes below zero. So traders did something clever. They borrowed money in Japan for almost nothing, converted it to dollars, and bought American stocks and bonds that paid a real return. Borrow at zero, earn 5 or 6% somewhere else, pocket the difference. There's a man for this, call him Kenji, a trader in Tokyo who's been running some version of this move his whole career. It's called the carry trade, and it quietly became one of the biggest sources of fuel under global markets. Trillions of dollars of it. Here's the problem. That entire trade only works as long as Japan keeps its rates on the floor. The second the Bank of Japan starts raising, the math flips. Borrowing in Japan stops being free. The yen gets stronger, which means everyone who borrowed cheap yen now has to pay back more expensive yen. And so Kenji and thousands of traders like him start unwinding the trade. They sell the American assets they bought with that borrowed money to pay the loan back. We got a small preview of this in 2024, when one surprise move from the Bank of Japan sent markets lurching around the world in a single day. Now Japan is raising again, for real this time, while the Fed is frozen. You don't need to follow every detail. You just need to know that one of the hidden ropes holding up American stock prices is being slowly pulled loose from the other side of the world, and the Fed can't lower rates to make up for it without making its own inflation worse. Now, here's why all of this matters for you, even if you never think about the Fed. When the European Central Bank raises rates, the euro tends to get stronger because money flows toward where it earns more. When the Bank of Japan raises rates, the yen tends to get stronger for the same reason. And when the Fed sits frozen while everyone else moves up, the dollar starts to look like the one currency that isn't paying you to hold it. Slowly, quietly, money can start to drift away from the dollar and toward the currencies that are still raising. A weaker dollar sounds abstract until you remember that America imports an enormous amount of what it consumes. Oil is priced in dollars, so is a huge share of global trade. When the dollar weakens, those imports get more expensive, which pushes prices up at home, which makes inflation worse, which is the exact problem the Fed couldn't fight in the first place. You see the loop. The thing it can't fix makes the thing it can't fix worse. If this is starting to feel familiar, that's because we've been close to here before. Go back to the late 1970s. Inflation was tearing through the country, and for years the Fed dithered, raising a little, backing off, hoping it would fade. It didn't. It got worse. Then a man named Paul Volcker took over the Fed and did the brutal thing. He jacked interest rates up toward 20% on purpose and held them there. It caused a sharp recession and a lot of pain, but it broke the back of inflation, and it's the reason prices stayed calm for the next 40 years. Here's the difference that should keep you up at night. When Volcker did that, the national debt was a fraction of the size it is today. The government could survive 20% rates because it barely owed anything by comparison. Today, the same medicine would bankrupt the patient. The cure that worked in 1979 is a cure America can no longer afford to take. This is what people mean when they say the Fed is trapped, and it's not a figure of speech. It is a closed room with two doors, and both doors lead somewhere bad. Raise rates, and you risk crushing the government's budget and possibly the economy with it. Hold or cut, and you risk letting inflation run and the dollar slide. There is no clean exit. There's only the least ugly option, chosen one meeting at a time. Let me give you the honest counterargument, because there is one, and it's fair. Some economists, including people at JP Morgan and Goldman Sachs, would tell you the United States is not actually stuck, it's just being patient. The argument goes like this. America borrows in its own currency, which means it can never truly run out of dollars the way a household runs out of money. Its debt is enormous, yes, but so is its economy. And investors all over the world still line up to buy US Treasury bonds because they're considered the safest asset on earth. By this view, the Fed is holding rates not because it's helpless, but because it genuinely believes inflation will cool on its own as oil prices settle, and it doesn't want to crash the economy chasing a problem that's already fading. That's a real position, held by serious people, and it might be right. But here's the thing that argument has to explain away, and I don't think it fully can. If holding steady were a position of strength, the Fed would be doing it from choice. It would have the room to raise if it wanted to. The tell is that almost nobody seriously believes the Fed could hike rates by 2 or 3% right now, even if inflation demanded it. The interest bill on the debt makes that close to impossible. So the patience and the paralysis look identical from the outside. And when you can't tell the difference between someone choosing to stand still and someone unable to move, you should at least consider that they can't move. So step back and look at the whole table again. Europe raised, Japan raised. Smaller central banks around the world are nudging rates up to defend their currencies and fight their own inflation. And the one seat that used to set the rules for everyone is the seat that can't act because it spent the last 20 years going deeper and deeper all in, one borrowed trillion at a time. That's the part that should sit with you. Not that the Fed made a bad call this month, that the most powerful financial institution on earth has slowly boxed itself into a corner where its single most important tool can't be used without breaking something else. And the rest of the world is starting to notice. Alex is still sitting on his savings, waiting for things to get back to normal. I gently suggest to Alex that this might be the new normal. A world where the referee can't blow the whistle anymore, because the referee is also the most indebted player on the field. So I'll leave you with this. Drop a letter in the comments. Drop A if you think the Fed is genuinely trapped, and this ends badly within the next couple of years. Drop B if you think America's size and the dollar's status mean it muddles through like it always has, and this fear gets overblown. Or drop C if you think the real danger isn't America at all. It's that everyone else raising rates while the US can't is what finally cracks the dollar's grip on the world. I read the comments, and I want to know which letter you're picking. I'm Easy Finance. I'll see you in the next one.